Good afternoon, everyone. My name is Janet Wright. I'm with the FSA National Outreach Office. I am National Outreach Specialist, and I want to thank you for joining us today for the ERP Phase 2 application webinar. So during this time, we will have our guests, which Ruby Ward and Guido Vanderhoven. They will walk you guys through where to find the information you need for these forms, for this form, and where to enter it and how to enter it, how to determine what information goes there. And so during the course of this webinar, you are able to put your questions into the Q&A box, and they will answer as many of those as possible during this session. And the slide deck from this session will be emailed out in a couple of weeks. Unfortunately, the recording will take longer, more like closer to 2 weeks. But as soon as we get it out, everyone who registered for this webinar will get that information. With those few housekeeping items, I'm going to turn it over to Ruby and Guido, and so they can get started. There's a lot of information going on today.
Thank you, Janet. I'm going to get it started, and then we'll turn it over to Guido a little bit later when we get into the example. And right now we are doing tax issues and applying for ERP Phase 2 benefits. And I myself, Ruby Ward from Utah State University, Guido Vanderhoven is on here. He's emeritus faculty at North Carolina State University. And JC Hobbs helped us put this together and has helped us do it in a couple of their venues, but he could not be here today. So you've just got Guido and I. We are both part of the National Farm Income Tax Extension Committee. I'm the co-chair, and we have various information on tax education materials located at ruraltax.org. We'll also give you this link and some additional ones towards the end of the webinar so that you have some resources to go back to, but there's information on various topics there on that website, ruraltax.org. This material is based upon work supported by the U.S. Department of Agriculture under this agreement number. The opinions and what we express here do not necessarily reflect the views of the U.S. Department of Agriculture. You can see the other kind of information here. I'm not going to read all of it, but rural tax education, we're all part of the National Farm Income Tax Extension Committee, and are involved at land-grant universities, and those universities also do not discriminate based upon race, color, religion, sex, national origin, age, genetic information, and you can keep going. So, and then we'll just get right into the webinar. So now that some of the housekeeping and the pre-part is done, this is really what we want to cover in today's webinar. We want to first go over where is your farm information located on your tax return, or the tax information, because that just kind of is going to set the stage for a little bit of this program. And then we're going to do a quick overview of Schedule F and some of the need to, and you're going to need that to extract some of the separate income details. We're also going to do an introduction of forms, FSA forms 521 and 521A, and also form FSA 510. Just there's another other training material on the ERP Phase 2 program. This is a little bit more tax oriented, but we do want to provide an overview of all of those forms and stuff to just kind of get us on the same page. And then we're going to get into a farm example using all of those forms, and that is where Guido's going to go through that example. And that should really be the meat of this presentation and where you'll probably get the most benefit. And then we're going to talk about some resources available. We've got some discussion questions or just items to consider at the end. And then we'll also take your question and answer. And please, as you are, I see some people are already doing that, type your questions into the Q&A, and then we will try to get to those. So where is farm income located? Sometimes we talk about the Schedule F for farming activities, and that is for farming activities, but not all of the farm income is located on Schedule F. You also have Schedule F for farming activities, Form 4797, where your breeding livestock cells are, your machinery and equipment. And then Schedule C, if you're doing some value added ag products, ag tourism, etc., you might also have some Schedule C for business income. And the Schedule F, over 98% of those farm returns are filed using cash accounting. So we're going to mostly go through an example using cash accounting, but we've got a slide towards the end that'll go a little bit over some of the issues that you might encounter if you're choosing to do accrual accounting on your Schedule F. As always, there's a need to have clear communication between the operator and tax professionals to find out what their operation includes and to include all of that. And you can't get a complete picture just from a tax return. And especially for this ERP Phase 2 program, you're going to need some additional records. And if a tax professional is preparing this for someone, some additional records, communication with them, etc.
Ruby, can I jump in just a minute? So there's been a couple of questions about partnerships and sub-S corporations. Those would be using Form 1065 for the partnership, or an LLC taxed as a partnership, or an 1120S if as a S Corp. Now the key is, and what the focus of this presentation is, looking at how we make adjustments so that we come to gross income from crop/plant sales. And we're going to be removing the livestock sales because there's a separate program for livestock emergency relief. But for those partnerships and those sub-S corporations, when I was a tax practitioner, I always prepared a Schedule F for those because it was the entity, whether it was the partnership, the LLC, or the sub-S, that would be the farmer. And so if the tax return was filled out without using a Schedule F as a supplemental document, then you would go to your records and you would pull out those items. We're going to use Schedule F because predominantly that's what we have, but we do want to recognize that there are partnerships, LLCs, and sub-S corporations that are the entity that is farming. And what you need to do is work with your accountant or your tax practitioner to pull and create those numbers as we will illustrate. So I just wanted to make that comment, Ruby. Thank you.
All right. Thank you. So we're going to move on. So additional information on farm income is located on the ruraltax.org website. There's some tax topics and fact sheets and also links to other materials. There's also materials on farmers.gov/taxes. And there's a webinar recording that Guido did that he's the one that just chimed in here on Schedule F line by line. And so that recording is now up there, and there's also links to additional materials. So those are both good places to go to for some additional details on this. And we will also go, and also your land grant universities, they're varied because some have more taxes and farm management than other states, but it's a good place to actually start also in your various states. So another item to consider is Schedule F versus Schedule C. And when we bring this up, it's really saying, where does the sales of certain products belong? Do they belong on Schedule F? Do they belong on Schedule C? It's, and on Schedule F, we take them to the first sellable point. So for milk, the milk would be on Schedule F. That's the first sellable point because there is a market for milk. It's sold in its original state. However, if we were making cheese, then cheese isn't the original state of that milk. And so technically it should go on Schedule C as a value-added ag product. So the cheese is a value-added ag product, but the milk itself would be raw milk would be the first sellable point. However, there is some provisions to have, and de minimis is just a fancy word that means a small amount. And so a small amount of value added, if it's a small amount compared to the overall operation, then that can go ahead and go on Schedule F. But if it gets beyond that small amount, then it needs to be separated out and on Schedule C. Also, your agritourism activities are the same way. And so when you have, you're growing strawberries and then you're also making strawberry jam, the strawberry sales would go on Schedule F, and then they would sell them to their value-added business, and the value-added business of the strawberry jam would go on Schedule C. How you make that sell and how you value that, you use a reasonable value. It could be the cost of production. It could be a reasonable value based upon other things, that places you could sell it if you keep track of that. And it's a good practice to just document that value in multiple ways and just keep those records. They might not have done it this way, so there's a need to ask the farm, to look at the records of the farm and ask questions there, but that's the difference between Schedule F and Schedule C. So a small amount of value added can still go on Schedule F. People say, what is a small amount? I've heard sometimes 5% or less, but it really just kind of depends, and it's not defined by the Internal Revenue Code. Getting into using the tax information for the ERP application, the items that you're going to need are the Schedule F. You're going to need, but that's not going to be sufficient. You're also going to need some of the farm records that went into the numbers that are on the Schedule F, because you're going to have to, as Guido mentioned, kind of tease out the grain and plant cells from the livestock cells. And so some of that you'll be able to do from the Schedule F, but a lot of that you're still going to need to have the underlying records that went into the numbers on Schedule F. And then you've got some FSA forms. There's Form 521 and 521A, and we'll go through those. And then Form FSA 510 is if you're over a certain threshold and you need to have it certified, and we'll talk about that. So, and we're going to use an example to calculate the input values for those forms. And Guido's going to do that in just a moment, but I'm going to go over what these forms look like before we start filling them in, to just so that you're aware of kind of what we're meaning when we talk about those forms. So here is the Schedule F. And I realize it's a little bit small to get it all on your screen, but the records, you're going to need the Schedule F, and then also the records associated with the Schedule F. So the details from lines 1A to 1C, and that's the sales of purchased livestock and other resale items. So items that you bought to then resell are on. So if you bought like calves and you feed them out for a while and then you resell them, that wouldn't be part of ERP either, but it would be on lines 1A to 1C, and we'd need to back that out of the other cells. It could also include some other types of things. On line 2 is the sales of livestock, produce, grains, and other products you raised. And so we'll have to separate the crops from the livestock from the amount on line 2. Lines 3A and 3B detail the co-op distributions, and we'll have to separate those out to make sure we get the ones that are associated with like grain and the crop cells. And then the government program payments, the same way. We have some details online. So you're not going to just need the details of what the amounts are on your Schedule F, but you're also going to need some of those underlying records. And then the CCC loan elections, the amount is on line 5. And then on line 6 is the crop insurance detail. And that is the bulk of what the lines are that you're going to need to separate out the amounts to get the appropriate amounts, portions of those that belong to the ERP Phase 2 program. And so here's your FSA 521 page 1. And so you can just see it goes through here and provides different information. And then here is page 2. And on page 2, you're going to be choosing for the disaster year, if it's 2020 or 2021. And then what year is the benchmark year and what year is your representative year? And then you'll fill in those totals. And then here is page 3. And page 3 of 521 is where most of the details are about what is actually included and what isn't included. And so here in table 1, this is a really good one to look back through. It's showing the Schedule F line numbers that you're looking at, and then what we want to include and what we want to exclude. And so you can see here for line 1C, we want to include the sales of eligible crops that were purchased for resale, but we want to exclude the livestock. And so that's what Guido is referring to. We're really separating out the crops from the livestock here. And then on line 2 of Schedule F is going to be the sales of products that you raised. And again, we want to include the sales of eligible crops grown, and we want to exclude the amounts from animals, eggs, milk, mink, and you can see kind of some of those, but it's mainly that we're wanting to include the crops and exclude the livestock. One thing that we get into the value added there, if you have sales of eligible crops that were from value added activity that was included on your Schedule F, then it's okay to include them here in the ERP Phase 2 program. It's just separating out the crops from the livestock. And then when you get down here to the Schedule 3 or line 3 on Schedule F, on the cooperative distributions, you want to look at the amounts that were related to the sales of your crops, and you want to exclude the amounts that are not directly related to the sales of the crops. And that would also include if you have co-op distributions based on items that you bought just for family use, then you'd want to also exclude that portion too. And then for A and B on Schedule F, that's the agriculture program payments. There are some of those program payments that you want to include, but you also want to exclude the ones that are related to conservation program payments, dairy margin coverage, marketing assistance loans, and so and all the pandemic type programs. And so this is where you're going to need those underlying records to really be able to separate these line items out amongst those that you want to include and those that you don't want to include. And then here on the 521A, page 1. Yeah, go ahead.
You skipped over page 4 of the 521.
Something seemed a little weird to me. Okay, so here we're just going down to the rest of the lines on your Schedule F. So line 5 is the CCC loans, and we're going to include those in gross income if we treated them as income and reported it to the IRS, and also the forwarded CCC loans. Line 6 on crop insurance, we're going to go ahead and include the crop insurance unless it was something related to mainly livestock type programs. And so if so, then we're going to eliminate the livestock programs on the crop insurance and keep the ones related to the crops. You're going to exclude custom hire income because it's not related to sales of crops. And then on line 8, other income, it really just kind of depends what it is. We're going to include commodity specific income received, but we're going to exclude programs that were the federal and state gas and fuel tax credits. We're going to exclude some of the other items like from hedging, wages and salaries and tips, cash rent, those types of items that aren't related to that crop production. And so this is just kind of an overview. We would recommend that you go through this page 3 and 4 in more detail, but and we're going to go through it again a little bit as we go through the example, and I think going through the example will bring this out. And so here is now the 521A, page 1. And so this is where in section C here, in section A, you're going to have the allowable benchmark year revenue, and that's in item 5. And then you're also going to, in section B, identify special conditions. And those special conditions are related to some decrease or increase in capacity. And for purposes of our example that we're going to go through, we're not going to have those special conditions of increase or decrease in capacity, because we want to just go through kind of the main part of it and not get into that. And then in section C is where you're going to put in the allowable benchmark year revenue. And so that's what, when we get to the example, we're going to go down through and show you how to find the amounts from section C. And that's really where you're trying to split out that crop revenue from the livestock revenue and only include the crop revenue. And then we just want to make you aware of when you're looking at the patronage dividends on line 11, you'll want to make sure that you split out what's allowable from the crop revenue and exclude the personal use or the stuff that those that arise that aren't directly related to the crop revenue. And then the same thing for the government program payments. We want to be able to, you're going to need those 1099s that came with those so that you can really go back and see what programs they came from and be able to split those back out. And then here's the 521A page 2 section D. And so this is the allowable disaster year revenue, items 17 through 24. And so similar to what we saw in section C, but this is for the disaster year instead of the benchmark year. And so we're going to go through the same process here for the disaster year with all of those various items from your Schedule F, splitting out in general, taking the livestock out, amounts out from the grain and the crop income. And you need to pay attention to the 1099s that you get from the patronage dividends and the government program payments to be able to only include the ones that you want to include. And here's page 3. Here's we get into eligible value-added commodities. And if you're a new producer or if you have decreasing capacity or increasing capacity, these sections may not be needed, and we are not going to be using these sections because of the example that we chose. But they're here and you'd fill them out under these conditions. And then we get into section H, the total expected disaster year revenue, and that would be items 38 to 41. And then section I for the total adjusted benchmark year revenue from a decreased operating capacity, and section J from the benchmark year from a increase in operating capacity. And we're not going to need sections H, I, and J are not needed if you didn't do E, F, and G, and those were not used or needed. So in our example, we're not going to need H, I, J, or E, F, G. Because we didn't do an increase or decrease in capacity. However, we will need to fill out section K, the total allowable benchmark year and allowable disaster year revenue. And then we come to the FSA 510, and this is used to apply for a waiver of a payment limitation of $125,000. So the issues to be aware of are if those government payments exceed $125,000, then you need to use this form. And the income values, if you're using this form, need to be certified by either a CPA or an attorney. And this is by statute. So there's actually a law that was on the books that said this needs to be certified by a CPA or attorney if you're under these conditions. We do have seen and do know that in some of our extremely rural areas, this may be problematic. You may be using a tax preparer that's not a CPA or an attorney. So just be aware that if you have this issue, that you may need the FSA 510, but only under these conditions. And so now I'm going to turn it over to Guido to go through an example. And this should really kind of bring those forms and how we go through the process of separating that information out on Schedule F for the ERP Phase 2 program. So go ahead, Guido.
Thank you, Ruby. And I do want to reiterate that our example is a sole proprietor. About 85% of American farms are sole proprietors, and 15% are either partnerships or some form of corporation. It still would be eligible in those. We're looking at the farming entity. And so as I mentioned in the earlier comment, as a practitioner, I would prepare a Schedule F for the partnership or the LLC or for the sub S corporation, because I also wanted to report on the K1 what gross farm income would be for the recipient of that K1, whether it be a partner, member, or S corporation shareholder. A C corporation is a tax-paying entity in and of itself. So there wouldn't be any flow through of that income, but the C Corp could be a farm as well. So let's look at this example. So we've got this particular farmer, Will Farmer, and he's going to make an application for ERP Phase 2. And so his job is going to be that he needs to separate the grain/crop income from his livestock. Now, Will is operating a traditional diversified crop and livestock farm that we would see very commonly in the Central Plains of the United States. Actually, JC and I used some of the Kansas Farm Management Association data, so these values are based in reality through the combination of several different farms that were of the same farm type. We're also having that Will is making an application for the 2020 disaster year, and that he's selecting that 2019 is going to be his particular benchmark year. And so we're going to look at those forms. We're also going to point out as we move through here, where, as Ruby did mention in her earlier comments and remarks, that Schedule F is a place to start, but it's not going to provide all of the information. You're going to have to go into your own farm records, and you're going to have to see where those items are. And I'll point those out as we go through. Ruby, could I have the next slide, please? So this being an income-based program, we're only going to focus on the sources of income that come in. We're not going to look at expenses. This is Will's 2019 tax return, and it's the part of that is the Schedule F that we see here, and it came out. Now you'll notice that we've got Part 1. He's a cash method producer, and as Ruby also mentioned towards the end of the presentation, we'll make a cross-reference back to the accrual. There may be some folks on the call today that do use the accrual method of accounting. And as you go through, and if you're familiar with Part 3, which we will illustrate and show in a little bit later, you'll be able to make connections with what you're going to have to do. So line 1A through 1B, in this case, we see that for this particular year, that Will had $200,000 worth of sales of livestock and other resale items. He has a basis in that, and you see that reported on line 1B of $125,000. So the $75,000 is what we are looking at. That's going to be the reportable income on this return, and ultimately we're going to have to split that out. We see that on line 2, we have sales of livestock, produce, grains, and other stuff that he produced, and that's a total value of $255,550. And this is where we're going to need to have our farm records again to split this out. And the cooperative distributions, as Ruby mentioned, we see there's $223,200, but you'll notice that there's a different amount on line 3B because some of that would be non-taxable if that was for personal items that they may have purchased, such as if there was a deli attached to the cooperative, as in some parts of the country. And so if we earn patronage based on some of that, that's going to be a personal use. So again, records are going to be needed to determine and split those out. Farm government payments, we'll see $65,200 in 4A. and we see 60,200 over in taxable amount, because in this case we had some market gain, but because he reported that income last year when he went under loan, that market gain does not get counted this year because we don't want to double count that income. And then you'll see Commodity Credit Corporation and loans under election. So here in 2019, again, he is making the decision to treat loans as income, and that's an annual election that can be either made or revoked. But in this particular case, he's going ahead and doing that, and he's reporting the $100,000. We see crop insurance proceeds. He received some in 2019. We just kept it relatively simple. We didn't defer. And so he's got the $219,000. So yes, we can defer crop insurance or any disaster payments. Remember, general rule is that if we sell those crops as a matter of business practice over time, and the general rule is 50% or more of those crops are sold in the subsequent year, then we can defer. Otherwise, what we have to do is we have to report that income. There have been several questions that have come up that I've in the Q&A, and the key point to remember here is that we are using what has been reported for the benchmark year and what have been reported for the disaster year. In our example, we're looking at 2019 as the benchmark year. So whatever is on the Schedule F, whatever it was reported for farm income, that's what we're going to use. If we didn't have any amount deferred, so in the example 6D, if you look at that line on the screen, there's nothing there. It's because we didn't defer anything from the previous year forward. But if we had, we would report it, and that's what would become part of the income for the benchmark year or for the disaster year, depending on which year we're talking about. Whatever is reported in the year, that's what we use. We don't make any adjustments for a production in another year. So I want to be clear about that. It's what is reported on the return for the benchmark year, or what is reported on the return for the disaster year. And then we see a little bit on line 7 as we carry on. In this example, we have $12,900, which was custom hire. And then we see $3,100, that's other income coming from gasoline fuel tax, etc. So this is our benchmark year. This is what we're looking at and where we need to move forward. And now we need to make some adjustments. Ruby, could I have the next slide, please? So just as a reminder that we were going to provide a Schedule F, or your partnership return or your sub S return is going to provide totals from various line numbers and from various farming activities. And then you're going to have those expenses obviously taken apart for net farm income. But what we are looking at here is gross farm income for this purpose. Line 2 may have both raised livestock and crop income. There could be, as Ruby pointed out in her presentation, some de minimis value added products that are reported there. And then those 2 pages that Ruby discussed and that we also point and encourage you to look at it for detail tells you what to provide guidance as to what to have included and what to exclude. Now, from your farm record system, as you can see on the right-hand side of the slide, you're going to have to review your farm records to separate the crop from the livestock enterprises. And you're also going to have to separate items purchased for resale in the crops versus the livestock scenario. And there could be some, do you have value added, and is it sufficient scale that you've been reporting it on Schedule C? Well, if it's on Schedule C, it's not includable. And just as I mentioned, in some cases, sale of farm business assets, that should be done on Form 4797. That again is not included, but if for those that may be aware, there are different definitions of farm income for income tax purposes. And we just want to make that clear that you need to look at it. for this presentation, for this program, we're looking at farming income as defined and reported generally on Schedule F. And again, we're using a sole proprietor as a example. Ruby, could I have the next slide, please? So here we have Will's FSA 521A, which Ruby introduced. And you'll notice that we've got his name in the applicant box there on box 1. We're making the disaster year election under section A, and that box ticked is 2020. So 2019 is going to be the benchmark year. 2020 is the disaster year. And in each one of section B for items 6, 7, and 8, we are checking no, and that is done for simplicity purposes, for the purpose of this particular example. And then when we go through, you'll see that those items E, F, G, H, J are not going to be needed because we've ticked no in this particular scenario here. Ruby, could I have the next slide, please? So just as a reminder here, we're transitioning a little bit. I want to draw people's attention that the worksheets do have some explanation and guidance. Again, we want to draw you folks' attention to line 3A, 3B, 4A, and 4B, where you're going to have to look at, there may be some differences on what was reported as a gross number and what was reported as a taxable number. But either way, you start with line 3A or you'll start with line 4A. You make the adjustments, you should get to the same point. And that same point is going to be, this is the income that directly relates to cropping. Ruby, could I have the next slide, please? Okay, so here what we've done, JC and I, as we looked at this particular example, we decided to create a spreadsheet that did a side-by-side evaluation. We have Schedule F, which will be the left-hand column, and you'll notice that those are line numbers. These line numbers all represent what's on the return. Then you look over on the right-hand side, and then you'll see the FSA 521A. This is the section C. So we're going through different calculations to look at what we need to place on that worksheet, that 521A worksheet. And you'll notice that on the worksheet, we refer to those things as item numbers. So we're looking at item 9, 10, 11, 12, 13, and so on. Ultimately, what we're trying to do is we're trying to get to an adjusted value for gross cropping income that we see reported on item 16. So let's kind of work through this. So the first one on Schedule F is lines 1A, B, and C. And you'll see that from, if you remember from the earlier slide, we had $200,000 of sales of purchased livestock and other resale items. And then we had cost basis of 125. And then we did the math. We now have a net margin there of $75,000. Well, where did that money come from? Well, $125,000 came from a corn that we sold. That was the corn that was under loan in the previous year in 2018, which we now paid that loan off to CCC. That was $100,000. And we turned around and sold it as the market increased, and we had $125,000. So when we paid that loan off, it would get reported on line 1B. That's that $100,000 that you see in the center in the red. And then we have the $125,000 worth of corn. So one would expect that our net from cropping is going to be $25,000. Well, we also had $75,000 worth of pigs, and we had a $25,000 cost. And so when you look at those, we're going to pull those two values out, which you see done in the right-hand column, 125,000, 100,000. And so yes, item 9 is showing that $25,000 net from grain sales that we had purchased back from the CCC in this particular example. Can we go down to line 2, Ruby? So line 2, this is the sale of our livestock, produce, grains, and other products. And coming from our records, we see that we had $143,750 of livestock, and we had crop sales of $111,800. So our line total, as you will recall, when we looked at Schedule F, was $255,550. Well, when you slide that over, we're only going to be able to use the $111,800 because that's our cropping income. And you'll notice that the $143,750 is in white. It's not highlighted. We're not using that number. So item 10 is going to be $111,800. That gets us then moving down through the form. We've got line 3, where we've got $223,200 in total. Now this includes some personal expenditures that we got, and we got some patronage from those personal expenditures. And so we had to look at our records. We removed those personal expenses. And so we're left with $222,900. That slides over, and you'll see the red arrow there on the right-hand side for item 11 as being $222,900. Again, we've made an adjustment, and it's only going to be cropping. Line 4A, again, we're looking at the agricultural payments. Now, remember that market gain, because we had potentially had a market gain from the previous year, that was reported in the 1099-G. And so we have to pull that out because we reported the full $100,000 as a income in the previous year. And in this particular case, it was 2018. And here's where it's really important to have that clear conversation with the tax practitioner or somebody that may be helping you, or if you're doing it, you have to be very clear that we're using the income that is reported on the return, but there is some interplay that comes in. We had $65,200, but we're only going to use the $60,200 because that's the eligible crop government payment less the market gain. We don't want to double count income. And that's why we've pulled the $5,000 out, because we had already, and it depends on what the farmer had made that election. Did they report income as the loans as income, or did they keep it at loans as loans? So item 12, which is the government income specifically related to crop production, is going to be $60,200. We have excluded the market gain, and you'll note that the market gain is excluded when you look at items 3 on page 3 in that 3-column guidance. On the next one, we have commodity credit loans, and here's the $100,000. So here, this case, we've made the election to report it as income, and so we're going to leave it there. It's going to be included in that line, and so you see line $100,000 over in the right-hand column because we are including that income. Line 6 is our crop insurance. And so in this case, we did not defer. We did report it. This may have been wheat income, wheat disaster, which we got typically in this example. We would be selling that wheat shortly after harvest, not carrying it over into the subsequent year. But again, it's just an illustration. You need to be clear as to what your business model is and how you did this in real life. We've reported this on the return, so it's going to be included on the 521A as item 14, and you'll see that in the right-hand column where the red arrow is pointing. Next one. Well, we don't use custom hire on line 7, so it's blanked out. You see that the $12,900 is white, it's not highlighted. And so we look also at $3,100 here on line 8 in the other income. That was all fuel credit. Since it was fuel credit, it's one of those items that's exempted. So it, again, is zero. We don't have a value for item 15, which then gets us down to the bottom, and that is item 16. So item 16 is $539,000. That's going to be our adjusted cropping income that's going to be coming for our benchmark year. You'll notice that we have $748,000, roughly $749,000. So we've been able, we've made that adjustment roughly of $210,000 between the two. 200 and that 210,000 is not included in that calculation for that benchmark year. All right. So we've generated all of those numbers. And now what we do is we look at 521A section C, and you'll notice that my spreadsheet had those item numbers 9 through 16. And here are those item numbers on 521A in that section C. We're just pulling those numbers over. And this is going to have been, Will would have made these calculations. 25,000, 111,800, 222,900, all those same numbers that I just illustrated how we calculated those comes in. You'll see on line 15, there's a 0 because we have no other allowable gross income that was related. And we do the math, we have that $539,000. That's going to be our total allowable benchmark year revenue, from which we're now going to compare, and we're going to end up doing and looking at the disaster year. Ruby. So what we want to do is we want to, again, separate those items between Schedule F. This is a transition slide that we want to look at and move those over. We're looking at those. It's the exact same process we just did, except it's going to be for the disaster year. Ruby, can we go to the next slide? So here's our disaster year. This is going to be for 2020. The benchmark year was 2019. So here we see that Will's again 2020, and you just look at the gross income just real quickly as a bench, looking at that line 9, 536. Well, remember we almost had $750,000. So we've had a significant change in income between those two years. So this would be then qualifying, you know, on the surface and as elected as the disaster year. Likewise, we had some sales of livestock and other items, and very similar to the 2019 year, we had some raised livestock, although it's lower number. We had some cooperative distributions, again, a lower number, indicative that our grain production was hit because of the disaster. We bumped up a little bit on government payments, but we have a $5,000 adjustment because we don't want to, again, double count that item. Commodity credit loans, you look at that, you see that we don't have anything there. We elected not to, we didn't have anything to sell, so we couldn't go in under loan with that. And prices were better than the loan price. So, and it looked like it was fair. So that was a decision that Will may have did make. We had some disaster payments that were received in 2020, and we went ahead and reported those. As you can see, 65,000. Remember, last time it was under 20,000. So now we've got $45,000 more in crop insurance. So that's kind of making sense. Custom work down a bit, and then other income 21,000. We've got those as well. And so that's our total. Ruby, can we go to the next slide, please? So here, looking at, we're now, the earlier slides we just saw were those that we see now on the left. Now we're looking at our disaster year. We've got exactly the same thing that we need to pull, looking at the difference between our corn and our pigs. And you can see line 1, we had $215,000. We have $135,000 worth of corn and $80,000 worth of pigs. So we're pulling those $80,000 worth of pigs out. And so the far left-hand corner is 135. We're doing the same thing with the basis, and just here illustrating that the posted county price was lower than the market price. We had $95,000 worth of corn in this particular example, and $35,000 cost on the pigs. We pull those out, and we're making that net value for item 17, and this is going to be looking, remember, at the disaster year at $40,000. Ruby, could I have the next slide, please? So here we're looking at our produce. We're looking at it from our enterprise records. We're looking at the livestock raised, 118, looking at cropping raised, 61,000. See that the 118 is not highlighted, therefore we're not going to use it. So item 18, which is our cropping only, is going to be $61,500. Co-op distributions. The next one that we look at that, we have 124,000 in total, but we have 123,000 that's going to be allocated to the grain. We've got $1,000 difference that's not going to be reported. So our item 19, which is going to be our cooperative distribution, that's going to be related to the cropping production, it's 123,000. Government payments, very similarly, we want to just look at the 58,000, which is eligible crops, less the market gain. We'll make that item and we'll pull that out at $58,000, as you can see over there on the right. Then our crop insurance, line item 22 is at $65,000, and that makes sense. This was a disaster year, so it stands to reason that we've got a little bit more crop insurance coming in. And then we've got some custom hire that stays out. But here we've got, because we were down, we have $21,000 of total other income, but 20,000 of that is going to be a reimbursement from fertilizers that we didn't use because we couldn't get in there. We didn't use all of the fertilizer, so we got a reimbursement. We've included it in as a cropping attached income. So you see 367,500, which is item 24. That's going to be our adjusted gross farming income from cropping activities, as compared to our gross farm income as reported on Schedule F of 536,000. Now it just works out. If you compare item 16 from the benchmark year at 539, that was $3,000 more than our gross farm income on the disaster year, which you can see just right next to one another. Next slide, please, Ruby. So we've gone through and we've looked at item D now. We've calculated all of these numbers for the disaster year, and now we're just filling in Will's 521-A form for those items that are eligible. You can see the 40,000, the 61,500, the 123,000, the 58,000, just as we've gone through. And now our total actual allowable disaster year revenue is going to be $367,500. That gets us to Ruby, and Ruby's going to kind of take us through the rest and kind of explain some of those parts.
So this is sections E, F, and G, and because we didn't have the value-added commodities or the increase or decrease in capacity, we didn't need to do sections E, F, and G, and so that's because of what we chose for our example. We wanted to keep the example a little bit more simple, and so if you did have those issues, then this is where you would put those in, and you may need to fill out these E, F, and G. And then because we didn't fill out E, F, and G, we also didn't need sections H, I, and J here. And so this is relating to if you're changed in your operating capacity. And I know there were some questions that came in the Q&A that what happens if our capacity was higher or lower than the year before. And so these are the sections that you'd want to fill out if you were under those circumstances to account for that. And so this is, but we, in our example, we didn't have that. And so we didn't end up filling out these sections. And so when we look at it, these item 16 down here and item 24, from our benchmark year and our disaster years, those are the items that we're going to keep. So that's item 16 is the 539,000 from our benchmark year. And then item 24 is the 367,500 from our disaster year. And we're going to take those two totals that Guido went through, and we separated out all of the livestock and the things that didn't count. And that's what we were left with that counted, that was related to the cropping activities. And so those amounts we're going to pull over into our section K, which is the total allowable benchmark year and allowable disaster year revenue. And if you look at that, because we didn't have those E, F, and G and the H, I, J, then we're going to use item 16 and item 24. But if you had some of those things, then you would fill in those other sections and you would look at the totals from these other line items. And then we're going to need to fill out the 521. And so this is what it looks like. And so here we've got to say what our, for the disaster year, what our benchmark year was and what our representative revenue year was. And so we're going to take those amounts that we had here, that $539,000 from the benchmark year and the 367,500 from the disaster year. And we're going to go ahead and put those in for years 19, our benchmark year, and 2020, our disaster representative year. And so this is what the 521 will look like with those parts included. And so part B is where you have your name, the producer, and we have Will Farmer. That's the example that we went through. It's a Kansas-based example. And then part C, because we're doing a 2020 disaster year. And so, so we're just putting in the 2019, and then we're the 539,000 for our benchmark year. And then we're checking 2020 and the disaster year revenue of 367,500. And so those are just put in here in part C. And then I'm going to turn it back over to Guido. And that was assuming that everything that again, over 98% of the returns are filed using a cash basis. But Guido's going to go over a little bit here with some differences in the accrual basis. So take it away, Guido.
Okay, thank you, Ruby. So late last week, we had somebody that I hope is on the line indicated that they were scheduled to attend today. And the question was, well, what about if I'm accrual basis? Because as Ruby said, most folks, 98% or better, file using cash basis. So a lot of the directions look at that net farm income on and looking at the guidance. Well, here is part 3 of the Schedule F, and this is found on page 2. So this is where farm income on the accrual method is going to be calculated. And what I've done here is looked at this item and then provided a place to reference where we made calculations in that earlier cash basis presentation and our cash basis example. So line 37, it's the line instructions, as you might be able to see on the screen. So sales of livestock, produce, grains, and other products. Where have we seen that line description or that line instruction? We saw that on line 2. So everything that I mentioned relative to line 2 is what you have to do here for line 37. Because ultimately, as you drop down to line 50, where you see is that for the purpose of the ERP, we want to have grains or crop only type of gross income. And this, as you look at the line instruction, it says enter the result here and on part 1, line 9. Well, what Ruby just illustrated in the previous slide was that we took line 9, which was gross income, and that's gross farm income, and we made these adjustments for not only the benchmark year, but also for the disaster year. And this is the same thing as what we can do here on this particular part. We are pulling out of those items. Line 36A and line 30 and 38. Sorry, my bifocals here. Line 38A and line 38B are analogous to line 3A and line 3B. So we'll make the exact same adjustments. If we've got some personal items and then we've earned some patronage on those personal items that we've done over the year, we need to make that adjustment. The same thing with agricultural payments. On this one, it's line 39A and B. Well, that's analogous to line 4A and 4B. Same process. We need to look at what did we receive those government payments for, and then we need to make that adjustment. The Commodity Credit Corporation loans, did we make the loan under the election? That's technically, and it's an Internal Revenue Code Section 77 election. It can be made annually. There's our line 5A, and you see line 5B, line 5C. They all match up with line 40A, 40B, and 40C. So the process is exactly the same to my understanding of what we need to do, because we're separating those out. Crop insurance proceeds, line 6A. Did we do those? Custom hire, line 7A is the same on the one, but here it's on line 42. Other income, line 43, there's our line 48. Well, if you now look at the next one, because with the accrual, what they're going to be doing is looking at the inventory values, if inventories are done, the same thing we'll do. We're going to separate the grains from the livestock, and this is going to be kind of similarly done with lines 1A and 1C that we just illustrated. And then when we get done, we should have just the cost of grains. That's our ultimate goal for this ERP phase 2 program, is that we're looking at grain/crops only. And so if we've made all of these adjustments, but we're using here part 3, not part 1, then the goal is that it's going to be grain only as the adjusted part. And that's going to slide over and be part of either the benchmark year or the disaster year. And I hope that that helps those that are using the accrual to do that, make those adjustments and can see those. So where are we at now? We're kind of wrapping up the presentation, and we see we've got some questions, but just as a review, we start with Schedule F. Whatever is reported on the Schedule F, regardless of when it was reproduced, we're looking at if we've deferred grain sales into January of the subsequent year, if we deferred crop insurance, if we deferred disaster payments, it's whatever is reported on that Schedule F for the benchmark year, and whatever is reported on that Schedule F in the disaster year. And I'm using Schedule F. It could be that you've got a 1065 and you've used the representative forms relative to that, and all the 1120S if you've got a sub S corporation. Again, the entity may be the farmer, but we'll have to pull those numbers out to get to what crop income is. It could be that on Schedule F, you've got the de minimis items. In the examples provided by USDA on page 3, they're saying, well, what happens if you raise strawberries and you produce strawberry jam and you report the strawberry jam on Schedule F? If it's on Schedule F, it's going to be treated as farm income. Now, we've used a de minimis value. When I was practicing and doing tax returns, I used 5%. And once it got over 5% of gross farm revenue, then I said, now this is starting to look more like a standalone business in and of itself, and we would move it to Schedule C. Schedule C income for value added is not included for ERP purposes. We'll use the 521A instructions. There's also a USDA tool to calculate the allowable entries as well from the farm records. We've kind of done it manually in this presentation. There are other presentations that have been made for that, and we'll provide the web link here in just a little bit on those. Then we look at 521A, and then we transfer those numbers. And in reality, we've done a lot of work on 521A to transfer 2 numbers to the 521. and that's looking at that. Then you're going to end up transferring those numbers, those appropriate values for the benchmark year and for the disaster year, and then you're going to sign and date, and then it gets turned in to the local FSA office. Ruby, could I have the next one, please? And so we've already seen this particular slide. Remember that if a government payment exceeds that $125,000 limit, then there may be the need to file the 510 for the waiver. And the reported income in this case has to be certified by a CPA or attorney. And as Ruby mentioned in her comments, this is by statute. This is not a USDA policy. So Congress put this in when they passed this legislation. Again, we recognize that in rural areas, this certification could be problematic because it takes time. The professional, whether it be the CPA or the attorney, they're going to have to do their due diligence to satisfy their ethical obligations as a credential holder. And it could be costly to do that. They may have to go back and review not only the application year, but they may have to certify the 3 prior years, and they have to look at that. They may not do a complete audit, but they will have to review those, and that's going to take time, and that's how they earn. In our example, excuse me, in our example of Will Farmer, we did not need to use the FSA 510 because the threshold would not be reached. So Ruby, I think, go one more slide, please. So as promised, here are some of those ERP resources. The big broad one is the emergency relief website. That's the first one that listed there on that. From that site, there are several items that you can look at for the 521 application, the 521A worksheet, and also the 510. They can all be accessed from that major USDA emergency relief website. And there are some other tools. The tool to help figure that out is also accessible from that point. So Ruby, you want to lead off and finish this?
Sure. Guido's, and I think that you've seen now, we're going through the example really kind of shows you what you're trying to accomplish in splitting out the items in that Schedule F and the review of the process. And that Guido went through. These are just some items that we came up with that we thought might be worthy of a little bit of additional discussion or just mention. And so to just kind of keep in your head and remember, the first of those is related to lines 1A through 1C on your Schedule F. And the items that are held for resale. So you bought plants or grain, and then you're holding those for resale. It's the net of the sale and not the total amount that you sold them for. And so that's the amount coming from line 1C. For value-added agriculture products, as Guido's already mentioned, so for example, strawberries that were grown and created, and the farmer produced strawberry jam and then sold the strawberry jam. To the extent that those are included on the Schedule F, they were included on that year's tax return, then they can be included in the ERP Phase 2 program. If they are included on the Schedule F, in general, that's a de minimis amount, and de minimis again is just a big word to mean a small amount. They can show up on Schedule F, and if they are on Schedule F, again, the take-home messages there. If it was included on Schedule F, then it's included in ERP Phase 2. For the cooperative distributions, the ERP Phase 2 program is the sales from specific crops like your grain marketing, and you want to exclude from those anything that you bought from the farm store for some of these other items or for personal items. The patronage dividends related to that, you want to make sure that you bring those back out and only include the ones that were specific to the crops. On the ag program payments, you want to exclude include the ones related to the crops, but we want to exclude the EQIP program because that's mostly for livestock. The CRP program, the wetlands conservation payments, again, that one also we're going to exclude the CRP payments. And this 3A, 3B, 4A, 4B, those are the government program payments and the cooperative distributions. And so this is just to highlight that you're going to start with what was included in 3A and 4A, which should match up to the 1099s that you received either for the patronage dividends or the government program payments. But then you're going to need to look at items that you need to exclude from there, either because they came from personal use for the cooperative distributions, or for something not related to grain sales, or in the same thing with government programs, we want to exclude anything that doesn't relate to your production of crops. And so of the eligible crops there. So these are items that we've gone over through the example and stuff, but we just felt like they warranted another kind of mention or discussion. Comments here on any of these, Guido, before we move on?
No, I think you've covered it nicely.
Okay. And then this is something that we also wanted to just kind of pop up here. Partly this is just if you have to do the FSA 510, but just in general, finding a farm tax expert, I think related to these types of programs, this comes up quite a bit. And so we do have some materials on how to choose a farm tax expert. And I think also these are good things that you can think about if you need to find a CPA or an attorney. We've got the direct links here, but on the ruraltax.org website, we've got a fact sheet or a tax topics, we call them, just short, just a few pages of an article on how to choose a tax professional. And then there's also, this is included in a webinar called Introduction to Agriculture Taxes that was included on farmers.gov, and we've got the link there. And so these are just some of the items that you can think about in trying to look for additional expertise in a tax preparer. You want to check the preparer's qualifications, any certifications they have, where those qualifications come from. Ask about their experience with farm, forest, ranch, or land returns, specific to some of the items that, you know, what's more similar to your type of operation. The farm taxation, there's quite a few rules that are different for farm taxation than for other types of income taxes. And so you'll want to ask about their experience specifically with that those farm taxation issues. Ask about their service fees, find that out up front, make sure the preparer is available. We found sometimes that preparers may check all those other boxes, but if they're too busy to get your return done or answer your questions, then that can be also problematic. So find out if they're available and what your access to them is. Ask how they handle some of the what we would call the gray areas. So one of those would be like when we talked about the de minimis amounts of value added, or the small amounts of value added that can be included on Schedule F. How do they handle that if that's something that you're facing, so that you can find out what they do with that. Find out their limits on audit representation. So if you end up having to go through an audit, it's good to find out if they can represent you on audits or not. And so there's some other information, but these were just a few things that can maybe help you as you're starting to find a tax expert, and if you're needing that help with what you're doing. And really just kind of think about it as these are some things that you can look at to kind of interview them if you're going to hire them to be your farm tax expert. Other comments on this, Guido?
No, I just would really reiterate what you want is somebody that is very familiar with agriculture, the processes and the practices of agriculture, because there are some special rules that do apply. There is not anything different about the tax rates, but there are differences in how the Internal Revenue Code applies, and there may be opportunities to exclude some income. For example, if there is some soil and water conservation, what you can do under Code Section 126. So they need to know ag production, they need to understand some of those special rules. But I think you covered it looking at their qualifications and their experience.
And also, I would just maybe mention that the time to look for a tax professional is not the week before your tax return is due, really kind of the earlier, and even looking at it during 2023, the calendar year, before you're wanting them to fill out a 2023 tax return the following year. So the earlier that you can work with them, the better usually. So we mentioned a few times that we have some tax resources available. We sprinkled a couple of references to these throughout the presentation, but in general, here's the places where we have information available. The first one is farmers.gov/taxes. That lists all the webinars that we do, like this one on farm tax issues. There's webinars, and usually upcoming ones about once a month is when we do those. And the recordings from the webinars will be there, and then links to some of the other materials. A couple that we've mentioned here that would be of value are one from July 12th of last summer on agriculture taxes, what new farmers should know. That includes the how to pick a tax professional portion. And then this year in March, Guido did a Schedule F, a line-by-line discussion. And so some of the stuff that we've gone through here, that recording doesn't mention ERP phase 2 and go into that at all. But as far as the discussion of what is included on a Schedule F and further details, there's a lot more detail there on that one. Ruraltax.org is the website for the National Farm Income Tax Extension Committee, of which Guido and I are members. And that includes tax topics, so short articles. And two of them that are related to today's presentation is how to pick a tax professional and farming and who's a farmer. And then also you can look at your land-grant university's extension programs in your various states. I do want to have a caveat there that various states and universities have different amounts from, some states have very extensive programs, such as the Iowa Center for Ag Law and Taxation. And then, and others don't do very much in this area. And then a new one is the agftap.org. And it can list some local workshops or presentations that might be done within your state. So that can be a good one to look for too. And so these are just kind of the general places that you might want to bookmark and go back to for just information in general. And Janet has also put these links for the farmers.gov, rural tax, and also the agftap.org into the chat, so you can grab those links there. And then the follow-up questions would go to Janet. And so I believe this is the last. I'm going to leave this up here so that you know how to contact Janet for follow-up questions. But I think that we still have quite a few questions that are open. And so I assume, Guido, should we just start kind of taking some of these questions?
Yeah, why not? Well, I'll start at the top and I'll start reading. And when I get tired of reading, you can answer. Okay. So we've got Sydney has saying she'd like to answer this first question. That question is, if the business was classified as a partnership in the benchmark years and is now a sole proprietor since the other partner was brought out, then how do we calculate? And she may have communicated directly.
I think that you talked about that one earlier in the presentation, so she probably just mentioned that it was going to be answered live.
Okay. Go ahead.
So the grower with losses in 2020 and 2021 needs to do an adjusted gross income and chooses 2018 as the base year. Can the 2018 adjusted gross income be different for the 2020 loss year and the 2021 loss year? This would be because the fruit trees a fruit farm with trees coming into production. So if you have trees coming into production, that would be those change in capacity. And so those sections, I can't remember exactly which one, but the E, F, and G and the H, I, J, those would be where you would want to fill out those sections to account for that change in capacity and the amount of trees in production that you have. If you, and then if you claim crop insurance on your return, the instructions state to decrease the income for premiums and fees. If you have no crop insurance income, are you still supposed to decrease the income by the premiums and fees?
Yes, you would. You would just put those on line 32A through F as premiums.
So on the form 521A section F, what numbers do you use for expected yield per acre and expected price per unit? In my case, it is soybeans. I believe that comes back down and is based upon your specific farm and your information, but I will let, is there somebody from FSA that wants to answer that one? So if you use taxable crop insurance proceeds or proceeds per year, you, in general, you want to use whatever was included on the Schedule F for that year, whether it's the disaster year or the benchmark year. And so the crop insurance proceeds are the same way. It's the proceeds that that are included on the Schedule F for the year that you're using as the benchmark year or the disaster year. And
That's the same question.
Okay, let's see. What if your Schedule F line 1C is negative? Do we use the number from the Schedule 1 F1A? No, I believe you still use the 1C, but that would just decrease your overall total. And so I'm assuming that you would run into that situation more in your disaster year than you would in your benchmark year, and it would just decrease your total. And it says it asks for taxable cooperative distributions. Wouldn't that just be line 3B? So 3B is the taxable portion and 3A is the total that would match up to your 1099s. But 3B may not, you might not include all of it because it should be related to the crop production. And so if you have any of the cooperative distributions that were like related to buying like feed for your animals and things like that, you'd still want to be able to go back to the records for the farm records and be able to split those out. Go ahead.
Okay, it says, I've seen some tax returns show sales on line 2 and then again on line 3A. If the amount is shown both on 2 and 3, it's double counting the crop revenue. So yeah, that's a big issue because 3 is where you get the cooperative, and sometimes you would get that reported twice, and that's where those farm records are really, really important to prevent that double counting. So it could be on 3A, but you want to make sure that it's not being double counted and reported on 3B. Now remember, to Ruby's point, IRS does match the 1099s. And so sometimes we're reporting the gross amount on line 3A in the case of cooperative patronage, but the taxable amount could be totally different. And you just need, but IRS is going to look at it and say, oh, 3A was reported, they're good. We don't know the specifics of what goes on 3B. And so they will check that out if that return happens to be selected for audit. So it does, to the point of the question, be consistent year in and year out how you're reporting that income.
So Sydney, I'm not sure if you want to unmute and answer the one about crop insurance. It just indicated that you'd like to answer that live. So just whenever you'd like to do that, go ahead and do that. And then do you want to do this one on the CCC loans, Guido? Do you include CCC loans when the loan is deferred to the following year?
Okay, so when the loan is deferred, or it depends on the election. If you treat loans as loans, it's not going to show up on the return until the crop is sold. But if you defer it to the following year, it's whatever is reported on that return. If it's reported for the benchmark year, then you're going to include it. If it's reported in the disaster year, you're going to include it, regardless of when that crop was produced. So you got to be clear on a couple of those points, but also is the farmer making the Section 77 election to treat loans as income?
And then I'm not sure, must we separate the amounts off 1099G into line 4 and line 6, as the tax program automatically puts them on line 4 from the 1099G?
It must be the disaster payments. Yeah, the disaster payments you would want, because those can be deferred into the subsequent year. So line 4A is going to be the total 1099G amount for the matching program, and line 4B is going to be what's going to be taxable. So you could pull those out, and so you could report what you're going to if the farmer is electing to defer the disaster payments from FSA into the subsequent year, you're going to split it out into line 6 on those and treat it that way. So yes, you'll need to do that. But again, that's why we've made this comment just a couple of times now. The tax practitioner and the farmer need to have clear communication about what's the business model and what are the elections that are being made.
And I'm kind of thinking, in the interest of time, maybe we should be scrolling down through some of these.
Okay, this is one I think, Ruby, we need to think about, and that is if the husband and wife have a joint venture. I'm assuming it's a qualified joint venture between spouses. Most of the expenses and income is on the husband's F. Some of the government payments are on the wife's F. Do you combine their Schedule Fs and split on their applications? If they're filing 2 separate Schedule Fs, I think there needs to be 2 separate applications for ERP, but I think that may need to be clarified by USDA personnel. A couple of people typing answers. FSA 10, what if AGI is negative number, had income loss for that year? I can't make 75% for zero, so CPA will not sign the FSA 510. I think that's an FSA policy answer. We've already answered the 5C negative question.
So it says, can we emphasize, let's see, it just popped different. Can we emphasize the fact that these applications are signed and completed by the producer's certification? The producers are responsible for reporting only the allowable revenue. FSA employees are not qualified to view the tax returns and advise producers, and they should fill in the application or the correctness of the completed application. So this is a producer certified program. The only would you need the FSA 510 and be certified by a CPA or an attorney if your payment limitation exceeds that $125,000 threshold. But this is a producer certified program, so the producer fills those out and will do that. So And it asks if there's additional information and webinars on how to complete the adjusted benchmark year revenue. There is I would go to those, I'm just going to go back to that line. And so I would go back to these websites, the emergency relief website, and any additional information should go into that website and be available there.
Several of these questions are talking about, do we look at deferred income or do we look at deferred crop insurance? We have got different contract sales. Just remember that for the benchmark and for the disaster year, it's what is reported in that particular year. It's what's on that return. 2019 returns should be done. 2020 returns should be done in the case of our example here. So, you know, if you've deferred those and, you know, you deferred 2020 income into 2021, it's not 2020 income, it's 2021 income, the year that it's been that it's going to be reported.
Here's one. Can you explain why you subtracted the $5,000 market gain in your example? I'm not sure what the $5,000 market gain they're talking about. Up here in light for items 9 and item 17, we want to include the amount from 1A and 1B that were related to the crops. And so we backed the livestock portions out of those. And then it's the difference between those, which is the amount on line 1C, which is the net, the sales of the eligible crops purchased for resale, and minus the cost of purchasing those. And so that's the $25,000. I'm not sure where the $5,000 is.
It's right here, item 12 in this particular.
Oh, okay.
So in the previous year, the farmer in our example treated loans as income. So he reported the $100,000. And then when he paid that loan back, he paid it back with $95,000 because the posted county price was to his advantage. So he had a $5,000 market gain. And what we did was we pulled it out so we would not have that amount doubled, because we would have the $95,000, as you can see up here, as the cost of that. And so we pulled that market gain out in this particular example. So again, it depends on what election did the farmer make. And if it was loans, if it was treated as loans, so it wasn't taxable in the year that he took out the loan, but he paid it back, he would have had a market gain. That market gain is going to be reported separately on the 1099-G. And then you would want to have that $5,000 be reported, because you want to make sure that that market gain is there. But in our example, we chose to treat loans as income. And so what we're doing is we're pulling it out so we don't double count. There's a question there, Northwest Farm Credit, patronage dividends, which are a return and interest paid, they're allowable revenue. No, I think that's a return on interest.
So there's a question about the FSA 510 asking if there's any exceptions to it if you don't meet the testing requirements but generate their income from all their income from the farm. Example, net operating loss carryover from the prior years. The FSA 510 is only if the individual program payment for that program is going to exceed the $125,000. So it's not based upon a particular year's Schedule F. It's if the program payment itself is going to be more than $125,000. the CFAP, let's see. I believe we can you report the difference in those, but you're not going to know what your full ERP phase 2 program payment is, because they're going to pay out a certain portion to make sure they have enough funding, and then they have to see how many applications come in and the total value of those related to the program money that they have available for this program, and then they will know. So we can't go, that's a calculation that FSA themselves would do and can't be done at this time. And I'm just trying to scroll through here. And there's a few related to that. And again, we can't say how much exactly the program payment's going to be, because they'll have to wait to see how much those differences come in compared to what funds they have available at the FSA.
There's a question about if they rented more ground in 2020 or 2021 versus 2019. Do I go and use section F to complete? And yeah, you would have a change in capacity. So you need to reflect that in those parts.
Yeah, I guess here's that. Yep. And I believe the deadline to file these forms at the FSA offices is the end of June, but maybe somebody should clarify that. And
there's a question about what's Will's potential ERP2 payment in the example. Well, we don't know, because in a conversation with USDA folks, there's they don't know exactly how many applications are going to come in, and they don't know exactly how much money is going to be available for ERP. So those two things, it's kind of in limbo a little bit from what I understand, and from that earlier conversation. They have a fixed amount just to kind of sort that out as a placeholder more than anything else, and that placeholder is just there just as a placeholder until all the applications have been made, and then they look at how many dollars they've got to spread around on those applications. So sorry, I can't give a more definitive number.
yeah, so there's another one related to, I think, the CCC loans. If they took out a grain loan for $150,000 but only claimed $100,000 as income, I'm understanding that we will only include the $100,000 would be included on the app. Is that accurate? If we repaid the $50,000 of the loan in the same year, would that reduce our payment by $50,000?
I'm a little puzzled that the loan was 150 and you only claimed $100,000 in income. My understanding is if you make the decision to treat loans as income, you have to have all of the loans, unless you're doing it under two different farms and you have two different separate businesses, then each business would have separate one. I'm a little confused by the question.
Yeah, so another one is about hay and feed, and do you file that for the ERP? If you have the hay that's fed to your own livestock, it's not going to show up on your Schedule F income because it's not sold, and so you'd only be using the amounts of sales, and so it's the crops that are actually sold. And I think that's about all we're getting to. Is that correct, Janet? I'm seeing you coming back on, so I'm ready to turn it back over to you if there's.
No, I think that's it. And I just want to thank you and Guido so much for taking this time out to go through this information with us. I want to thank the FSA team who was in the backgrounds answering questions in the Q&A. Those Q&As will be pulled and they will be posted to the ERP2 page under the frequently asked questions. It will probably be late this week or early next week when that happens. Again, the slide deck will be sent out here in the next couple of days, but it will probably take a couple of weeks to get this recording up and posted to the website. As soon as that information is available, it will be emailed out to you also. And so if nobody has anything else to add to today's webinar, I will close it out now. So once more, Ruby, Guido, either of you have anything else to add in?
Well, thank you for the opportunity, and we hope that it was useful.
I would echo Guido's comments that, yes, we are glad that hope this is some, and I see the claps and thumbs up. So thank you so much for those. And we are happy to do this.
And we do recognize that everybody has individual circumstances. Each farm is unique, and it is difficult to create an example that would be useful across different types of operations. But again, we just hope that it was useful and helps people understand the process a little bit better.
Thank you guys again, and everyone have a good afternoon.